I was going to start by saying about 2 weeks ago, I was at a conference about this size, similar caliber, and I noticed that my favorite moderators were wearing sneakers. So even though I have never worn sneakers before to a financial services conference, I chose them here today. So I hope that's my power move, but you can't see them. So I'm sorry for that. I'm Jessalyn Dean. I'm the moderator here today. I am the Vice President of Tax Information Reporting with Legible Digital Asset Tax and Accounting. I'm going to let each of my panelists introduce themselves in a moment, but our panel today is about digital financial services tax and whether this is sufficiently different from conventional traditional financial services to warrant separate taxation policy. And our lens very well fits into the opening remarks that we heard from Ali, which is to balance the competing interests of inclusion, financial inclusion, fairness, international development, market movements, and even refugee crisis. So this is a very topical setting here today. Before I let the panelists introduce themselves, I'll just give a little bit of the layout of how we're going to do this. This is going to be very conversational, but we're going to start with a bit of the lay of the land, agree on definitions and words that we're going to use before we get into what is sort of the current lay of the land with digital financial services taxation, and then kind of look to the future and our crystal ball and where is the market going. So with that, I'm going to, I'll hand to Danish first. If you'd like to introduce yourself, tell us a bit about your work, your background in a few sentences, and then we'll get into our lay of the land and defining some words.
Yeah. Hi, everyone. Good morning. My name is Danish Mahbub. I'm a journalist with Bloomberg Tax, and I'd just like to thank Ali as well as the whole Hansuke team for the opportunity to speak to you all today. So I cover corporate taxation as well as international tax matters. Some of my reporting ranges from covering legal cases in the UK that HMRC fights all the way to the developments of the OECD when it comes to the global tax agreement on Pillar 1 and Pillar 2. Hoping to shed some light with you guys about what my reporting has directed me towards, as well as some of my opinions here today with you all. And I'll pass it over to the next panelist, Paul.
Thanks, Anish. Paul Applin. I'm a former president of the Institute of Chartered Accountants in England and Wales. I currently sit on the ICAEW Tax Faculty Board, the Chartered Institute of Taxation Council, Confédération Fiscale Européenne's Tax Technology Committee. I should tell you in between all this, I'm actually retired.
Failure.
I advise 4 different software companies, shortly to be a 5th. And I spend most of my time these days talking about tax and technology.
Oh,
yeah. Hi, everyone. I'm Awa Diouf. I work for the International Center for Tax and Development based here in Brighton. We work mainly on tax policies in African countries, and I work currently on the taxation of digital financial services in Africa. So all those specific taxes that African countries apply to collect more tax revenue from mobile money, for example. And it's a pleasure to be in the panel. Thank you.
And which countries have you specifically focused your research on in Africa again?
So I work a lot on Ghana, Uganda, Tanzania, Kenya, and Senegal.
Perfect. So maybe a little bit of joke, maybe a bit of truth. When I was asked to join this panel and moderate, I went to Google, what is digital financial services tax? Not because I don't know what it is, but because all of us use different terms in different ways. I even see this in my own work. So I focus in my advisory work in the last 10 years of my career is in tax transparency topics. So someone might need the context to know, is she talking about OECD, CRS, FATCA, CARF, DAC 8, or is she talking about ESG reporting and some of the other terms that sometimes people will call tax transparency, ESG reporting? So in my career, I've heard tax transparency used to refer to both of those. So I had to look up, well, which context are we talking about here? And so with that background, I thought we would start here to say, let's all agree what is digital financial services tax. So we're using the same language before we then dive into the meat of the question, our very first topic. So I'm going to hand to Awa first. tell us digital financial services, that, what is it? What is it not? And then digital financial services tax from your work. And then I'll ask my other panelists to react. And there is no right answer. We're just setting the baseline here today. So we're on the same page with our audience. Awa.
Yeah, so in my work, we define digital financial services as all those financial services that are provided to users, but are done through an electronic device, like a mobile phone, a tablet, or internet. And I define a digital financial service tax as those specific tax instruments that African countries or maybe other countries are applying to digital financial services in order to increase revenue. And in most cases, those are desperate tax measures and easy to apply taxes that government apply when they are in a desperate need of tax revenue. For example, during the COVID-19 pandemic or the Ukraine war or other climate shock that they went through, they needed more tax revenue, and it was a good way for them to apply those taxes. So it's different from VAT or usual excise duties that are in a general tax code, different in a way that they are not justified by a negative externality like taxes on tobacco or petroleum products, but they are just justified by a need to collect tax revenue. And they can be applied to transaction values, transaction fees, or operator turnover. But what they have in common is that they are usually applied to tax consumers, so the final consumers, and rarely to tax operators. Thank you.
I like that frame. It's sort of the absence of a justification, like a VAT typically, or an excise tax has a specific justification to it. Paul, any reaction to how you might use this phrase?
I'm in pretty much the same place as you. I'm thinking in terms of mobile banking, internet banking, e-wallets. Perhaps if I want to be a bit more creative, I might think about electronic point of sale systems, basically any digital mechanism for processing a transaction that is an identifiable point that you could, to pursue the rest of our theme, that you could tax.
And Danish, would you include crypto or digital assets in the bucket of digital financial services and talk about it in the context of digital financial services tax or any other change to our definition or addition?
No, I would include crypto assets and cryptocurrencies in that definition as well. To me, digital financial services would mean putting a levy on money transactions that are done through digital applications like Robinhood as well as Coinbase, and that may also trade other financial instruments like stocks and shares as well as crypto assets. So these taxes can be simple flat levies that apply on mobile money transfers all the way to profit that's gained on crypto assets that's taxed with capital gains taxation. So that's my view to it.
Okay, and we'll get into each of these in a bit more. So we've laid the land about what is digital financial services tax. So we're going to get into the bulk of the main question that we've asked, and then we're going to explore some side quests in this conversation, depending on where we go with it. So I'm going to start with you. Headline question, from your research, your work, or your own opinion, are digital financial services sufficiently different than traditional financial services to warrant separate taxation policy using our lens of financial inclusion, international development, market changes in market conditions as our competing interests? Are they sufficiently different?
So mostly, I think that the main difference between digital financial services and traditional bank services is that services like mobile money help poor people to have access to financial inclusion. So I know well the African case, and in Africa, it's difficult for some people to have access to traditional bank services. So I think that that is the main difference. And from that, government should apply policies that would encourage the usage of services like mobile money instead of applying tax policies that would maybe tackle their development. So I think maybe they are different in that way, but because mobile money is for poor people to have access to financial inclusion, I think that those policies could be revised in order not to harm their financial inclusion.
And tell us a bit about what happens from the work that you've done. There's many African nations that have implemented digital financial services tax, and what are the outcomes, considering, have they collected a lot of revenue? Like, has it worked? And how has it affected the behaviors of the actual individuals, taxpayers? Primarily, these are people of lower income.
So about tax revenue, I can give the Ghana example. So Ghana applies a tax to electronic transfers, and it's fixed at 1% of transaction values. So during the first month of application, the Ghana Revenue Authority only had 10% of what it wanted to have at the very beginning. So there are many issues. So people started to do protests. They started to let's say decrease the way that they are using mobile money at the very beginning. But then at the end, they just realize that they can't stop using mobile money because it's convenient and it's the way for them to have access to financial inclusion. So even if those services now are more expensive, they are still going back to mobile money. But at the very beginning, in all countries that these taxes has been applied, people protested and were strongly against it.
And from the countries that you've researched, do you see every country, if they tax digital financial services in mobile money, are they applying the same taxation principles to traditional financial services? Or do we see some countries that do one but not the other?
That's a very good question. So in Ghana, for example, there is an exemption threshold below which you can send without paying the e-levy, right? So that threshold for mobile money is 100 cedis. So I can send up to 100 cedis without paying the tax when I use a mobile money account. But when I use a bank account, the threshold is 20,000 cedis, which means that there is clearly a difference of treatment between mobile money and bank transactions. So, and the funny thing is that the 20,000 cedis for bank is not in the law. It's just a consensus between the state and banks, which means that maybe banks have a stronger lobby than mobile money operators. And it's interesting to see that. Why and how they justify it, it's a very good question, but that's what they apply.
So from some of the reports, the research that I'd read, this can change then the market structure for these products and how people use them. As you described, there was this example where people stopped using some mobile money products when the laws were released, and they either went back to cash or they reverted to traditional banking services if they had access to it. And this can affect how the markets operate. Do you see this as a negative? What are the other negative consequences to this, other than I'm sure that the mobile money operators would not appreciate this because there's sort of a competitive advantage?
I just happened to look up because I don't know off the top of my head the exchange rate of the CD. The guy in New CD currently trades at $8.49 to 100 cities is $8.49. So it's a very low threshold that they're taxing on.
Yeah.
So I just
Thank you.
Yeah. Thank you. So the effect on the products that people are using, if they start moving between mobile money or cash, reverting to cash, this change in behavior, what are some of the negative consequences of the behavior changes?
Well, so I think that the positive impact of mobile money on poor people has been, let's say, argued by many studies. So some studies say that when poor people use mobile money, it can help them have better living conditions, it can help them save money for when there are shocks, it can help farmers, etc. So when government applies the taxes on mobile money services, it can obviously decrease their financial inclusion, so have negative impact on the initial positive impact of mobile money on them. So this is the main negative impact that these taxes could have. And what mobile money operators say is that the government should include them more in that policy-making process because they have good ideas, right? So they think that instead of taxing transfers, government should maybe tax withdrawals, because then people will be encouraged to use their money electronically. So instead of withdrawing the money and then pay by cash, they would just pay by mobile money. And in the long run, it can have a sustainable positive impact on domestic revenue mobilization, because the government would be able to track all transactions, for example. So I think it's just about putting all stakeholders together to think about better tax policies to collect revenue, but not harming financial inclusion.
And it also seems that in some cases, this could actually lead to decreased revenue. If you aren't taxing the tradition of the banking transactions the same as the mobile money transactions, then if people start sort of swinging between the other, then you can actually end up with lower revenues than you had planned for.
Yes.
Because going to the competition does not produce the same output. Paul, politics and policy. Why do we tax things? What is your view on digital financial services taxes?
This is going to sound very glib, but I think to an extent we tax things because we can. It's I wrestled with the question quite a lot. Are digital financial services sufficiently different from conventional financial services to merit separate taxation rules? Maybe they are, maybe they aren't, but I don't think that's how taxation rules come about. Taxation rules come about because of two main drivers. One is governments need to raise revenue. Statement of the obvious for this morning. The second reason taxes come about is because governments want to change behavior. And a lot of what you said, Awa, very clearly illustrates that second driver for tax policy. So when I say rather glibly, you tax what is easy to tax, if you walk around certain parts of London, you'll still find houses where you can see there were once windows. They're blanked out now. Why? Because once upon a time, there was a window tax. When beards were in fashion in the 17th century, there was a tax on beards. Suddenly, beards went out of fashion. You walk around Amsterdam, all those wonderful tall buildings. Why are they such wonderful tall buildings? Because they were taxed on width. So the taller you built to a low width, the less property tax you paid. Something that's easy to tax attracts the attention of governments and of tax authorities. So I think a transaction-based thing like digital financial services is an obvious target. It's a really easy thing to tax. But then you have to start wrestling with those two opposing questions. Is it more important to raise revenue, or is it more important to change behavior? And Awa, you gave some absolutely fantastic examples of why the behavior change is often much more important than raising the revenue. And I think Uganda, when Uganda started a tax on digital financial transactions, it initially taxed deposits, transfers in, transfers out, and withdrawals. The effect was a 50% drop in the number of digital transactions. Guess what? Uganda changed its taxation policy to tax only, I think, deposits, or was it withdrawals? Suddenly, the number of people making digital online transactions went back up again. There's that tension between raising revenue and actually driving social change. And I think that is where you probably move in this city from the Treasury on one side of the road to Parliament on the other side. There are people in darkened rooms in the Treasury thinking about ways to tax these transactions. There are people the other side of Parliament Square thinking, what is it we actually want to achieve?
And first of all, I loved that he knew that fun fact about Amsterdam, because as someone that lived there for 4 years, that was always my fun fact that I gave to my guests, because they would ask me, why are the stairs so steep in your apartment? I was like, well, actually, it's tax evasion. So you're the only other person I've met that knew that fun fact. And also there's an interesting point in there, which is from what I read, Awa, in a number of the African countries that are looking at this as their tax revenue. A lot of it's due to the difficulty in obtaining income tax from the informal sectors. And in some of these countries, it's possible that 60 or 65% of their revenue comes from transactional based taxes, such as this one, and VAT as example. So again, to your point, you tax it that way because you can. Danish, what are your thoughts on this headline question? Are digital financial services substantially different from traditional financial services to warrant separate taxation policy?
So I think to a degree, there are 2 points that I'd like to make. The first is when it comes to crypto assets, and I do think that the question does depend on the underlying use of the technology as well as the extent to which the technology is developed further. But the multifold purposes behind crypto assets make them, in my mind, different in terms of what sort of tax policy should apply to them and the reporting policies that should apply to them. So there are big changes to come for digital financial services providers that are going to be providing crypto assets when it comes to the OECD's development of the crypto asset reporting framework. That's moving forward at a quick pace, and I know that the development of that framework is at a final stage when it comes to just the format that has to be finalized. That's coming out in 2025. And by 2027, countries are going to be rolling out with the exchange of information for crypto assets. So given that timeline and the standardization that's coming into the market with crypto assets, I think there's going to be additional policies that are going to be built on top moving forward to specifically target these sorts of financial instruments. And on my second point, when it comes to digital services taxation, I also can see that there might be scope for financial services to be included in digital services taxes, given that the scope so far and how countries have been rolling out these types of taxes has been quite vague. You do have situations such as in the UK where there are exemptions for financial services and online marketplaces that are in the legislation, as well as the OECD putting forward that there should be carve-outs for financial services too, but that's not the case that might apply across the board, especially if there is a failure at the OECD when it comes to rolling out Pillar 1 and the digital tax agreement when it comes to the reallocation of taxing rights over multinational profits. So if this proposal fails, then digital services taxes could see a proliferation around the world, and financial services could be one of the targets that come under this type of taxation. So those are sort of my 2 points on that.
And what I've seen in the field of crypto, digital assets, and blockchain is, and I think, Paul, you said this the other day when we were chatting, it's a new technology. There's a lot of governments that don't have the capacity or knowledge to understand them. And so you always look to find the thing that you do understand that's kind of closest to it. And so a lot of governments are still struggling with how to tax crypto and digital assets and blockchain transactions as a result. And there's people in the industry that would argue that with crypto and digital assets, that rather than trying to find the square hole that your square can fit into, that you need to completely rethink and create a brand new set of taxation principles. Do you agree with that? Or would you lean more towards finding the existing relatable taxation principles and leveraging those?
Say the better use case is to find existing principles and leverage those, especially at this particular time. But once again, given the decentralized nature and multifold purposes of crypto assets, I think that moving forward, the development of the technology continuing, there could be a reason for there to be new tax policy applied. And that's probably the simple answer at this stage.
Awa, I wanted to ask, in if in this context, we've been talking about some of the research that you've done and other research on taxation and financial inclusion, international development, fairness. Do you believe that the research out there is comprehensive enough right now? And if it's not, what areas of research do you still think are still needed? In my opinion, application to digital assets and crypto is one of those areas. What are your thoughts on whether the research is comprehensive enough?
I think the research on the impact of DFS taxes on many stakeholders is still at its early stages. So I think it's important first to see who is paying those taxes, right? Is it poor people or richer people who are paying those taxes? And how people are paying those taxes. For example, is my mom paying that tax when she buys rice, right? Or is a rich person paying that tax when he buys cheese, right? So it's important to see when, how, and who are paying those taxes. And it's also interesting to see the impact or the effect or the incidence of those taxes on domestic revenue mobilization. Is it worth it, right? The tax revenue that governments are collecting, are they worth it to collect when poor people are suffering from those taxes? And it's important also to see if poor people are actually suffering from those taxes, because we know that transactions drop after the application of those taxes. And in Ghana, when I was interacting with mobile money operators, what they said is that it's not really about rationality or the fact that when the price increases, demand decreases. It's about protest. It's about political aspect, because people are tired of paying taxes without seeing the impact on their living conditions. So I think there are many, many things we can do out there for researchers. And I think that it's important to do that because policies have to be based on evidence so that our tax system would be more efficient.
And I think in the crypto, digital asset, and blockchain space, the current dialogue that we hear, or that I hear everywhere, is not this one about who's paying the tax and are they of a poorer class. It's about whether people are paying taxes at all. That the conversation is always that transactions in crypto and blockchain and digital assets are solely for tax evaders. And this is one of the conversations that I have when I'm talking about implementation of CARF and DAC 8, is not just hunting down tax evaders. It's the people that do want to pay their tax, but don't have good information in order to do it. The people that do want to comply and their ability to do so. So I think the research in blockchain and digital assets is far from this conversation of who is suffering the most tax, because the conversation is stuck on they're all just a bunch of crooks. The next question I want to ask, I'm not going to point on one of you specifically, so someone just chime in who feels inspired to answer this one.
Can I actually just go back on some of
Yeah,
this
please.
very briefly? Danish, you talked about crypto and fitting things into a box we understand. I think that is the temptation. First of all, you try and find something that fits. So in the UK, cryptocurrency transactions, the easiest box for most transactions was the share pooling rules within capital gains tax. That was a neat box. It happened to cover most bases. So that's kind of where we've landed. But I think as the whole world of crypto and tokenization expands, we are going to have to be more creative in the way we think about these things. We won't just be able to keep plastering over the same old paintwork. Or if you do plaster over paintwork, you know what I mean.
Yeah.
You can see why I did tax for a living, not interior decorating. I think there are two other things that really struck me though. One is, this isn't just about the behavior change in getting people to do their banking online. If you can get people to embrace digital services for one reason, they will probably stick with digital services for another reason. So if I was sitting in that darkened room at the Treasury at the moment, I might think, one of my biggest problems is the informal economy and the cash within the informal economy. If I could drive more people to do their banking online, if I could drive them more to digital channels, I drive cash and a large element of evasion out of the system. So maybe I don't want to overtax. Maybe I want to encourage people in. If I can encourage people in, maybe small entrepreneurs can have a whole different way of being taxed. Russia does this. If you're a small entrepreneur, you can have the Russian Federation banking app on your mobile phone. And if I want to sell a piece of tax advice to you, we can just tap our mobile phones. The invoice exchanges, a copy goes to the federal tax authority. And I know what my tax liability is straight away. And guess what? I can pay it digitally. We think about self-employment, about small business as a periodic thing for taxation. We think about sets of accounts. I'm a chartered accountant. I naturally think about sets of accounts. But for very, very small businesses, you could, in a digital world, reduce these things to transactional taxes and tax them in real time in a completely different way. That's a long, rambling way of saying there's a longer game here. Getting people onto digital tax platforms is not just about the way they do their banking. It could change other things fundamentally. And on blockchain, let's be optimistic. I don't think about blockchain as just a technology to hide things. Think about CRS. Over 100 jurisdictions exchanging information automatically. That's a great thing, but it's done by way of over 4,000. I think it's something like 4,200 bilateral agreements.
And XML.
And XML. Wouldn't it be great if you did that on a permissioned blockchain?
It would be.
So it's all in one place and you just permission to allow the tax authorities you want to see it, and you don't give permission to those you don't. I think blockchain is kind of dismissed a little too much. I think it could be transformational, but don't hold me to that.
We are going to come back to this point of how we tax humans. But you said something else that I think is the segue to the question I was about to ask. So that's perfect. So whoever wants to answer this first, but we'll of course gather everyone's comments. As part of mobile money transactions, you lose privacy. So people's rights to privacy is not a universal concept. Each human's perspective of a right to privacy is not, that's not a universal perspective in every world. This, we could go a bunch of different arms with like central bank digital currencies. A lot of people are worried about those on the blockchain because of privacy issues and the government being able to see everything that you do. So we do have to find the balance of, well, we're looking for more revenue from the informal economy. If we get them into digital services, banking or non-traditional banking services, that increases revenue. But how do you balance that individual's privacy where it matters with that perspective? So, what is the balance of privacy versus these transactional taxation? We can also think about CSOP, which is coming, which is some reporting in the EU that's going to really give a more intense view of taxation of specific transactions than, for example, CRS or FAT could give, because that's an annual reporting. And many times it's aggregated. So yeah, just opinions about the balance between privacy and this transactional tax when we use the lens of financial inclusion, international development, et cetera. Who would like to take a stab at their thoughts on privacy?
Okay, let's chuck another stone in the pond then. I'd think about the question differently if we were looking at things on a different scale. And I promise I won't go down this rabbit hole for very long, but I'm kind of heading towards it because of a webinar I was doing yesterday where we were talking about high net worth individuals and their inclination at times to hide things. And I think hide is a very difficult word. And another word that tax authorities like to use is secrecy. And I think there's a difference between secrecy and privacy, and it's really important to understand that difference and to maintain it. I had clients who had very, very low incomes who were passionate about secrecy and privacy. They didn't want to share their financial affairs, but it was because they wanted to keep them private. It wasn't because they felt they had a secret. When we look at the kind of scale we've been talking about today of people on very low incomes, people with few assets, I think that question is equally important. They have a right to privacy, but the real politic is there's always a trade-off between privacy and what you get in return. So I guess pretty much everybody in this room has a mobile phone or a smartphone in their pocket. Are you absolutely 100% sure that you've got the microphone and the camera switched off in every application on your phone? I'm not, because actually I'm not that worried. The ones where I am worried, I've switched those devices off. But there's a trade-off for me. I'm happy to have the functionality. I've lost a bit of privacy. I know I can be tracked. Do I care? No. So it's a trade-off, and I think it's an individual trade-off. It's one it's hard to have blanket thoughts about.
I think this ties in with the opening remarks that we had from Ollie, in that, as an example, people in a refugee crisis are not going to trust that the information about them won't end up in the wrong hands. And so privacy doesn't always mean, I just simply don't want the government to know about my things. It can actually put people's lives in danger. If you're trying to get everybody off of cash and into some sort of digital transaction, it can put people's lives, actual lives in danger. I was given a time signal. I think we have less time than we were originally allotted. But so I'm going to jump to, I'm going to skip the how do we tax humans one, because we could go down a whole rabbit hole. But I want to ask Danish, is the OECD the right forum for this topic, or is it somewhere else?
So there's currently a debate about whether the OECD is actually the right forum for international tax policy making, and the UN has taken a position about starting their own tax cooperation framework that currently has 3 options on the table, and it's being debated by member states in the 73rd General Assembly currently taking place. So for the time being, my view is that the OECD does have the technical prowess and the ability to come up with effective tax policy that has been shown by BEPS, as well as now BEPS 2.0 that's been moving forward at pace. But in terms of the inclusion of more voices, fairer voices, and having more of the views of the global South come into play, especially when it comes to these key topics like digital financial inclusion, as well as how crypto assets should be treated, maybe in countries that are not always represented in that discussion, then the UN in the long term probably does have more clout in coming up with tax policy, especially in that arena. Also based on where CARF is going, where DAC 8 is going, and having more standardization with reporting, more understanding about what crypto asset transactions are taking place globally, and with understanding how many countries might also be involved in this rollout. Looks like it's going to be quite a number by 2027. Then I think by that time, also seeing where the UN could be in terms of its tax policy making framework will be really interesting, and could potentially show a lot more results moving forward. So in the long term, I would say maybe the UN could be the place where international tax policy making should be going.
Great. So to wrap up, I'm going to ask each of you to look at your crystal ball of the future, either where you think digital financial services taxation will be or where you hope it will be. Hopes and expectations, we'll call it that. And feel free to fit in here, because we ran out of time, how you think humans should be taxed. If we should be moving away from income-based taxation, you can just sneak that into your crystal ball. So I'll start with Danish. What's your crystal ball tell you?
So I think I've been providing crystal ball expectations this entire time. But the three main points that I'd still bring up for crystal ball expectations, one would still be that last point that I made about the UN being perhaps the next place where international tax policy making will be going. There would be more capacity building opportunities coming out moving forward as well, especially with what you're seeing with the contributions that are being made by the African Tax Administration Forum, as well as the Platform for Regional Tax Cooperation in Latin America and Caribbean countries, probably helping out with the rollout of CARF globally. And then lastly, I'd also want to point out to the EU's work on the BFIT proposal, which I think could create more standardization at the EU and potentially add tax policy that would be more standardized for crypto assets as well as digital financial services moving forward. The EU's already had a past proposal for a financial transactions tax that was not moved forward, but that could also be reseen, as well as an EU-wide DST potentially. So that's some of my summarizations for crystal ball expectations.
That's your crystal ball. What does your crystal ball tell you?
Not much, actually. It's difficult to predict desperate tax policies, right? We would have to predict the COVID-19 pandemic or the Ukraine war or climate shocks. But what I hope is that tax policies in Africa will be based on evidence. I hope that governments would be brave and ambitious enough to target wealth, to target the digital economy, or to fight against tax evasion and tax avoidance, instead of applying those easy tax reform that could harm financial inclusion of poorer people. Yeah, thank you.
Great. Paul.
Okay, my crystal ball is a programmable crystal ball, so I've told it what I told it what I wanted it to come up with. What I'd like it to come up with is a view of digitalization that looks at the potential and the possibilities and the upsides, rather than the easy victim to tax. I think we should be looking at how we can use digitalization to affect change, kind of social change that we've talked about, how we can look at taxing things in completely different ways, how we can move from a world of accounts and periodic taxation to a world of real-time taxation. I don't think we can go all the way, but there are countries that have demonstrated we can go a long way pretty fast. And if we think about encouraging the take-up of digital services, we can add more and more and more. And if I wanted to dangle an attractive carrot to governments and leave you with a thought that is probably going to make you lose sleep tonight, it would be digital currencies, programmable digital currencies, where you could, for example, as a government, pay state benefits as a digital programmable currency, where the value of the benefit could be changed over time. If you wanted to drive consumer to consume, you might program that digital currency to have a high value. Once it had had the effect, you might want it to have a low value. You might want people on state benefits only to spend their state benefits on certain things like food, like essentials, and not luxury goods. You could program a digital currency to do that. It's been done. So the final words in my programmable crystal ball are think big, look at the long game. It's far more interesting than short-term taxation.
So Paul's going to continue being a retirement failure while he works on this. My final statement is a call to one of the later panels that is on tax transparency, ESG. I want heads of tax to factor in digital financial services taxation to or transactional taxes generally into their tax integrity, tax justice, tax morality considerations. And I think you can leverage a lot of the knowledge that was shared here today. How can there be greater transparency at the corporate level around corporate absorption of DFS taxes versus passing it on to the end consumer? And how does this affect people of lower income classes? And what is the role of the financial institution themselves in this process? So with that, I want to thank my fellow panelists for a great discussion. And that's it.